thanks very much, and thanks everyone for coming to this panel session. I think it is appropriately titled The Big Debate. I really think it is a critical and big debate at this moment, and we've got a very interesting group of panelists here. On my right here, Gianni from CopperBank, who's going to talk to us about his experience driving a Tesla across America. Then we've got Gait, Analyst from Bernstein. I'm sure many of you are familiar with Paul's excellent research notes. And then we've got Ryan from Adamas Intelligence, who's a real guru on rare earths and also other battery metals. So I think we've got a great panel here to discuss this topic today. I'd just like to kick it off from a very big picture point of view. There's obviously a lot of talk about EVs, but they're only still about 2% of the global fleet. So, Gianni, my first question to you is, is this real? Is this happening?
Yeah, this is an interesting topic, and I am an oil and gas investor. I am a natural resources investor. And I associate lots of my time, including my vacation time, with people that produce these products. My first 10,000 hours of experience was studying electrical systems, jurisdictionally. So what I did is I wrote a book about a young electrician who took his family doctor on a journey of enlightenment. And we talk about China and many topics. To emphasize this important topic, to do my book tour, I purchased a Tesla and I drove across America. And I engaged with various people within the media, within the industry, within society. And you look at three things that are happening at the same time. The first question is, will customers adopt these products if it's there? And when I talk with people, not for me, oh, not for my family, oh, the range, oh, that's too expensive, doesn't work. That's wrong. I drove across America on purpose the difficult way. There's no issue. This little company, which I'm not going to name, it's a technology company, they solved the puzzle. That's the first question. The second question is, the incumbents who have been so embarrassed, they've been so lazy, they didn't want to pivot the model. There's no interest in it. There's very few components in the electric car. There's very little service in the future for these cars. So the dealer network doesn't like it. The unions that make the parts in the cars, they have no interest in it. But it is changing. They are making it because they don't want to become BlackBerry or Kodak. And the third thing is governmental and jurisdictional pressure because of pollution. They're putting a gun to the head of the manufacturers, and then will the consumer adopt it? Absolutely. Most people do not realize they haven't tried it. They don't know what they want. MIT did a fantastic study. They had many people. Does it work for you? Of course, most people said it doesn't. Then they tracked the GPS in their phone. 87% of the people, the respondents, with today's technology of EV, it works for your life. So what we need to do is do a deeper dive into this, what will the application be, and you always start with the world's largest market. It is not the United States, it is not Japan, it is not Western Europe, it is China. In 2006, they surpassed Japan with units. They went above, it was 6 million units they went in 2006. The economic crisis happened, they're 27, 28 million units. 1/3 of the vehicles that are manufactured and sold in the world occur in China. And what are they doing? What are they doing governmentally and jurisdictionally? Without question, 10% of the cars sold in the world are going to be electric in the near future. Now, I don't care if it's 2023 or 2026. And the majority of the cars that are being adopted first wave are those that operate 24 hours a day. Taxis, FedEx carriers, buses. So when they talk about 2 or 3% of cars are EVs, oh, they don't impact oil. I disagree. It's a line item. And then you also have efficiency. The internal combustion engine, when you make it more efficient, you use less petroleum products. When you adopt to electric or make an electric motor more efficient, you use more copper.
Right, so you're saying a shift is happening and the implications could be bigger than people think, and consumers want electric cars. So if we look at raw materials, we do see the incumbents, as you said, coming in now, trying to get onto the EV bandwagon, which Tesla has sort of pushed them to do. But they're having problems sourcing some of the raw materials to build out this battery supply chain. So Paul, I just wanted to get your thoughts on this, because we have seen a sort of standoff now between Volkswagen and some of the cobalt producers, maybe even some of the lithium guys. Sure. So I just wanted to ask, is this a sort of bottleneck at this very early stage for this rollout of EVs?
Well, I think, is it a bottleneck now? Probably not. Other than perhaps with the exception of lithium, if you actually look at the current level of the sort of supply-demand balance, and you say, look, yes, okay, it's 2%, and within that, the mix of plug-in hybrids and so on and so forth. Are you seeing it at the moment in the supply-demand balance? Is at the margins, you're beginning to, right? But it's not as if you can't see your way to clearing that market at the moment. But you make any kind of forward-looking projection, you run it forward 5 years, you run it forward 10 years, and then you look at the penetration rates and the range of possibilities that you could see there. And very, very quickly, yes, it does become, a headache. And when we say sort of bottleneck, again, is there an absolute constraint here? Is there a sort of Malthusian limit here that we're going to sort of run up against the sort of limit and say, well, no, we cannot have this dream because there simply isn't enough nickel? I don't think that's the case. There isn't enough nickel, there isn't enough cobalt, there isn't enough lithium or whatever it may be. That's certainly never the case. The question is, can you have enough of it at today's price? What does the price line have to be to equilibrate the acceleration in the supply that you're going to need to meet that demand expectation? And I think that that's the sort of critical point. Can you sort of sit at a $10,000 a ton nickel world and expect people to invest in grade, class 1 nickel production? No, clearly not, right? Can you sit at, the world where we were, even just 18 months ago, right? 24 months ago, where you had people in the market sort of talking about $4,000 a ton in perpetuity for the copper price. Everybody will generate a negative return on capital, and yet we still want to see, well, this is clearly an absurd kind of worldview. So I don't think there's an absolute bottleneck. I think if you provide the financial incentives to create an allowable investment, then yes, ultimately we can have all the raw materials that we require. The question is only ever, are we going to create that financial incentive? Are we going to create a value proposition for the mining industry to get behind it and actually deliver those raw materials?
Well, you talk about price, but if we look at cobalt, we've seen prices go up a lot, yet still the miners aren't giving in to VW or the car companies. So is it a problem of concentration of ownership, concentration of supply, at least for cobalt?
Well, look, for cobalt, the question, clearly the issue. Look, if you had to pick any commodity that would cause me to scratch my head, I think it would be cobalt. The issue, I think, isn't the concentration of supply, though that perhaps doesn't help. The issue is, I think, the byproduct nature of the metal, right? You've got an industry, 100,000 tons or whatever it may be of cobalt at the moment. You look at where that cobalt came from, and it grew up almost entirely as a consequence of the production of other commodities, of nickel, clearly, and of copper in the DRC. I think that's the problem. Is you look at the incentive price structure of the cobalt industry, either from sort of nickel laterites, or eventually the sort of the copper deposits in the copper belt. It's very difficult to see, well, what is the price dynamic that actually creates new supply in an industry without there being the incentive or the ability to grow the primary metal? And I think that that's the problem there. So yes, you will see, of course, with the price going up, there are things and there are mines and there are sources of production that you can see coming onto the horizon, at the moment. So again, I don't think there's an absolute bottleneck, but we really do need to see, critically, both the copper and I think the nickel price move up as to create enablers for then the growth in cobalt supply as well. So it's that sort of complexity. It's the byproduct nature of it that changes, I think, the economics really of the cobalt industry. But again, in the short term, if you're Volkswagen and you come out and you say, let's have a year's worth of annual production at a flat price below spot, this is lunacy. Right? What are you going to get? And then the person you go and ask is Ivan Glasenberg.
Say no more.
Like a genius to work out what the end of that conversation is going to be.
So, but do you think on that point that perhaps there needs to be a new model with car makers and raw material supply? And someone this week suggested if you looked at silicon, often they paid to help, the solar guys paid to help develop the silicon projects. Do we need that sort of alliance between the end users, battery makers, car makers, and to help put money into these mining projects?
I think that's certainly a very interesting model. It gets back, we were just discussing in the green room. If you go back to the origins of the Ford's, the original rollout of the automobile as a mass consumer product, what it required was the company to get into the upstream, to get into actually putting capital behind the iron ore mines in the US, the rubber plantations in Latin America, actually securing access to raw materials by putting capital at work in order to facilitate that. Now, I'm not saying that you have to go to a sort of fully integrated model, but certainly a dynamic perhaps where there is capital put at, whether or not it's in the upstream or in, for example, in lithium, where it's clearly the refining and the processing side of things that needs perhaps more capital, to be put at work there. Alternative financing models, I'm sure will play a role. That speaks to essentially lowering the cost of capital for the industry, because at the moment the cost of capital in the industry, particularly given where the commodity prices are, is essentially too high to facilitate a significant acceleration in the supply base.
And Ryan, I just want to get your thoughts. I mean, obviously China is going to be heavily dependent on this supply chain. They don't want to see price gouging in certain sections of it, right? Especially if, the eventual buyer is a state-owned company. They don't want to be held hostage to price gouging or monopoly over supply. I mean, do you think they are going to go further upstream to buy more assets?
They absolutely may. I think if we look at what's happening in China broadly on a policy basis, the focus, I believe, with the Made in China 2025 initiative is to really focus on the downstream aspects rather than upstream. Certainly it wants to go upstream to ensure it has that security of supply at the right price, but I think it's recognizing that these mining industries, they're billion-dollar industries, at least at the mine site, and they're feeding into trillion-dollar industries that they want to own 100% of domestically. So I think they will look upstream insofar as to ensure that they have that supply, but I think it's really a small concern versus where they want to be in the next 10 years.
I mean, I would say, if you sort of look at, say, for instance, 10K, right?
Yeah.
I mean, that's a sort of classic sort of case in point. I mean, they were prepared to pay, significant, well, actually, if you look, I think actually bargain basement prices, but in the end of the day, at the time, people were talking about it being that. But then you look at how they were able to finance that, essentially, at a cost of capital, right, that was well below the cost of capital that we're seeing, applied more broadly across the mining industry. You look at the multiples that are paid that the London-listed major mining companies trade on, and you look at the multiples that, say, China Moly trades on, and that gives you a sense of the difference in the cost of capital. But I mean, to the point about a sort of billion-dollar industry feeding into $1 trillion, I think you're absolutely right. But without that billion-dollar industry, the trillion-dollar industry is worth zero, right? Without the supply of raw materials, there is nothing else. They are the sine qua non of all economic activity, whether or not it's just building rebar for construction, or lithium carbonate for the EV market. It's not so much, I think, the value proposition as without it. It's a sort of it's more of a sort of binary consideration, I think.
Yeah. So in that case, do you worry that China is going to lock up a lot of the raw material supply? I know there was a fear when 10K was bought by China Moly that a lot of that supply would be earmarked for China, but they didn't in the end get the refinery in Finland. Yeah. But I mean, overall, if they are worried about raw material supply and they have a cheaper cost of capital, are you worried that they're going to lock up a lot of these assets?
We'll see what it looks like in 5 years' time. Huh? I mean, we're not yet at the point, right, where those raw material, we're not at the point where it is, I think, where there is genuine competition, right, between, say, China and, say, between the West. But when push comes to shove, if you own the upstream, what are you going to privilege? Your trillion-dollar industry that you've just built for yourself from scratch, or out of the goodness of your heart, right? Are you going to prepare to liberate that supply so that Volkswagen can get it and steal a march on you? I mean, I think the reality of it is that they own these assets for one, and for one reason only, and that's to maintain and control, the primary factor in production, which is, as it's always been in human history, raw materials. So am I worried about it? Yeah, I would be very worried about it if I were any kind of policymaker sitting here in Europe, looking at a longer-term vision of manufacturing capacity at home versus that kind of ability and willingness to deploy capital. Okay, and that's interesting. And when you look at the Western big miners, I mean, obviously they are looking at this sector now. We've seen reports of Rio looking at a stake in SQM, which is the Chilean lithium producer. I mean, but this is still small markets for these guys, right, compared to copper and iron ore. But then, they face the fear that China could buy some of these assets. But do you think they will, either of you, they will buy stakes in lithium, cobalt, battery metals? I mean, lithium for me, I've sort of taken a slightly sort of heterodox view maybe on that. At the moment, I would sort of say for me, that wouldn't be the place where I'd be deploying my capital if I were one of these guys. But certainly, you look at, say, consolidation in the copper industry. I mean, again, let's just run it back a couple of years, right? Yeah. There was an opportunity there, a once-in-a-generation opportunity for some of these big miners to actually flex their balance sheets and consolidate assets. I think they missed a trick there, right? I think next time round, if we see a similar sort of period of weakness in any of these sort of major commodity markets, I doubt that they're going to respond in the same way that they did. I think that they realize they missed the trick, and that's come back to haunt them in a certain sense. Now that the market has turned, people sort of demanding growth, demanding expansion, sort of saying, look, how are you going to increase your footprint? Which is why, of course, we get these comments around them looking at things like SQM. But if it's for me, and I look at these markets, nickel, copper, right, cobalt, these move the needle. Right, and that's certainly where I'd be sort of putting my money if I were them.
That's interesting. Okay, we'll come back to that. Ryan, I just wanted to talk about rare earths a bit, because this is one area where China does have abundant resources. And of course, Deng Xiaoping said, Middle East has oil, China has rare earths. So what's their strategy around that? Because rare earths obviously are in the magnets, in wind turbines and in motors for electric cars. So they're in a very advantageous position for this time round, right?
Yeah, they certainly are. So I hate to go back to what I just said, but I think, again, the focus is on the downstream aspect. They certainly don't want to lose that seed that feeds into the trillion-dollar industry, but I think they've gotten to a comfortable point with their monopoly where, okay, if we can get monazite from a foreign producer, we're just as happy to do that as we are to mine it domestically, perhaps even more happy. They certainly do hold the cards when it comes to feeding these metals to the automakers globally that need them. You mentioned that they have abundant resources, but I think it's fair to note that rare earth elements are definitely not rare. It's a horrible terminology in general. There's abundant resources everywhere. They're just capital intensive to develop. With the price volatility we've seen in recent years.
Do not leave bags or packages unattended. Please
just a moment, I'll finish that.
Suspicious bags or packages to reception or a member of staff.
Thank you for that.
Okay, so.
Kind of lost my train of thought a little bit, to be honest. So they certainly do hold the cards with respect to rare earth supply. Rare earths are inseparable from the electric vehicle revolution as we see it. And I actually see them as being perhaps the biggest blind spot in the battery metal supply chain. So as many of you are likely aware, rare earths are used in the magnets that are used in the motors that are sold in most EVs today. These motors are about 15 to 20% more efficient than an alternative motor, an induction motor, meaning that you need to throw 15 to 20% fewer volts at that motor to get you 1 mile of distance than you would with an induction motor. So if we encounter a situation in the future where rare earth elements, particularly the neodymium and praseodymium that are used in these magnets, that are used in these motors, if we see a situation where those rare earth elements go into short supply and automakers now need to revert to an inferior motor type, then all of a sudden they're selling electric vehicles that go 15 to 20% fewer miles than they did in the previous year. Well, that's an unrealistic future. I think we all recognize that second to price, vehicle range is perhaps the most important consideration for somebody looking to buy an EV. So all of a sudden, what they need to do is increase their battery size by 15 to 20%, increase their consumption of battery metals by 15 to 20% to continue delivering on that range promise that they've built up this customer interest, this customer loyalty on. So I really view rare earth elements as being the biggest blind spot in the battery metal supply chain, even though they're not part of the battery metals boutique, or bouquet, if you will.
I'll just give one anecdotal story that when speaking with the people that created the motor for Tesla, they did it internally, and they wanted to have a made-in-America solution. So what they decided, they went with the AC induction motor. It's not a permanent magnet motor. And they wanted to have something that would be light. It's only 70 pounds. And it has a tremendous amount of horsepower per pound. And they did achieve this. They did this around 2011, 2012, and they worked together with the Copper Alliance. And the magic weapon was using a very special copper rotor. So 18,000 revolutions per minute, 70 pounds for a tremendous amount of horsepower torque. And it was exactly so they would not be beholden to something that could not, in the distant future, be a made-in-America solution. There's also a collateral benefit. When you have such an AC induction motor, you can actually repair it. The permanent magnet motor, typically, if something was to have a catastrophic fail inside it, you throw it away. You have to buy a new one. So this motor, which is repairable, they figure you can drive 1 million kilometers with this electric motor. And this is the same motor that Nikola Tesla created 120 years ago.
And no
very
rare
robust.
earths in it.
No rare earths in it. So it is a copper rotor motor. And when you look deeper in that, I already commented the internal combustion engine. When you make it more efficient, you use less fuel. 55% of the world's oil is used in transportation fuels. But if you go to the electrical side of the equation, in America, 45% of America's electricity is consumed by an electrical motor. Now, I would think that would echo itself in other jurisdictions, but I don't have the exact statistic. When you adopt or use fuel switching or efficiency, it means you're going to add more electrical motors to the stock of electrical motors. When you make an electrical motor more efficient, you use more copper. And then you look where these things are sourced. We've already talked about oil, and many countries in the world produce oil, but 45% of primary copper supply comes from 20 mines. That's it. Yeah. And what has happened with the grade of these 20 mines? You guys wrote a report some weeks ago where the reported production grade was 1.2% in 2010. Last year it was 0.72%. So if you're mining 30 million tons a year, now you have to mine 40 million tons a year. And being in the copper industry, I sometimes have to simplify it even to our industry. It's math, as Paul has suggested. If you have 1 ton of copper ore and it's grading 1% copper, at $3 a pound, it's worth $66. It's that simple. Of course, that's not the future of copper mining. I can show you a list of 100 projects that are in operation or the future of copper mining, and the EQ grade is roughly 0.5% copper equivalent. Your ton of ore is only worth $33 at $3 a pound. If I'm generous and I take copper to $4 a pound, that ton of ore is worth $44. Now, the future of mining is at 3,000, 4,000, 5,000 meters of elevation, 200 to 1,000 kilometers from deep tidewater. Everything that goes up the mountain and comes down the mountain must be paid for. It takes $15, $20 to mine and process that ton of ore. But then don't forget, this is new production. You have to pay for the facilities, the debt on it. You have another $15 or $20 you have to pay for. Even at $4 a pound, there's no margin. There's a reason that BHP Billiton told the industry that 75% of the future of copper production, the inducement price, just to get started, is $3.50 per pound. Look back historically. All the activity in the oil business occurred with approximately $100 a barrel oil. Yeah? 2006 to 2012. All of the activity in junior mining for copper occurred 2006 to 2012. The average band was about $3.50 a pound. Copper, it's in a very stealth manner, it is decoupled from many commodities. It's trading in the low $3 range. But it's still not economic. You really have to go down the food chain to find something where you can sit there and process that ton of ore at that elevation, that far from tidewater, with the added political risk. Because the future of copper mining is not going to occur in Arizona or in region 2 or 3 of Chile. This is just not that's not where it's going to happen.
Mm-hmm. So,
just to add to Gianni's point, though, I mean, I just agree with pretty much everything. Well, actually, not just pretty much everything he said. But I'd also just add, I mean, if you take those 20 largest copper mines, and as he said, that's 45–50% of the global production today. The average year of discovery of those 20 mines was 1928, 3 generations ago, right? That we found the world's best deposits. Now, there are 1 or 2 exceptions to that sort of, to that sort of rather sort of bleak, worldview. But this is an industry that was built 3 generations ago. We haven't found anything better than that over that intervening horizon. You look at the amount of exploration spend that went into the so-called super cycle, right? You look at the ability of that exploration spend to deliver incremental tons to the reservoir of possible investable projects. The reality is that this is an industry that is getting incrementally harder and harder and harder. We have never had depletion rates that have been as high as they are now. We've never had grades that are as low as they are now. We're facing a situation where, completely irrespective of electric vehicles, we need to urbanize 2.5 billion people over the next 30-year horizon. According to McKinsey, we're running a $50 trillion infrastructure deficit, quite irrespective of electric vehicles. Yeah. All of this is going to require copper. And yet we sit here where there are those agents out there that have price forecasts for this metal and worldviews about the role of mining as an industry that are completely at odds, it seems to me, with the reality of what will actually be required to meet those demand expectations. And then we had electric vehicles on top of that.
Yeah.
Then we had renewable energy on top of
Yeah.
that. Then we had distributed storage and grid stability on top of that. All of this requires, well, the set of metals really that we've got in front of us. But the sine qua non of that, from my mind, is copper.
No, I agree. I mean, a lot of the sort of urbanization plans put forward by the UN and others don't really consider the raw material aspects, do they? But I do want to say, why is the market not recognizing this? Why is the market not recognizing
I have a very good answer for that. If you go back to 2003, there was an invisible hand in the global economy. Of course, it was China. It had an output of $2 trillion, and now it's $12.5, $13 trillion. No one saw it coming. It caught everyone off guard, including the mining industry. So Phelps Dodge, which they had been in this torrential bear market for 30 years, when the copper, they hedged forward copper to 85 cents. Then it rose, at $1.25 they hedged more. Now, if we were speaking, we understood the copper cycle, and I was investing in copper for many different reasons because of this invisible hand. They were taken over by Freeport-McMoRan, and the rest, as they say, is history. Today, when you look at the invisible hand in this economy, and because the energy pivot is once in 100 years, we're having this sort of directional change, increased electrification. So we talked about the $150 billion that has been invested in R&D, exploration, and mining the last 10, 12 years. We didn't find anything. Biggest success story was Oyu Tolgoi that went into production. 2027, it'll be 500,000 tons of output. The invisible hand today is something you cannot model. The per capita copper consumption in the smallest village in Africa before was 0. Today it's a line item. And anytime you multiply a small number by a very large number, that becomes a very large number. So what's the installed copper base in the developed economies? In the United States, it's about 650 pounds per person. Japan, 600 pounds. South Korea, about 550. China today is about 170 pounds per person. I will suggest to you that you're going to see 2 or 3% growth in copper, almost irrespective of what happens to the global economy. Almost irrespective of that. It's just going to go like this. But the invisible hand now, and I spoke with my friends at CRU, and they're the ones that model these things. I said, I challenge you. How is this possible? That is a difficult task, because how do you go to the smallest village in Africa and start putting a numerator on the solar roof and the basic cabling and a couple of batteries and the hot plate that they will now have for convenience for their first electricity? You can't do it, but it will surprise to the upside, in my opinion. You could see copper demand growth 4 or 5% at times as this electrical economy manifests itself. And there is nothing coming in supply. It's not the will, it's the money. It has to make economic sense.
But just finally on this point, I mean, you do see China remarkably still consuming about, 40% of the world's copper? And obviously they're going to become less copper intensive, so surely you have to counterbalance that against the demand.
I think that the sort of copper intensity is something of a misnomer. I mean, metal intensity generally, I mean, there are a couple of sort of points to raise. The first of which, right, a lot of people talk about China, they say 30, 40%, 50% of the world's metal consumption. Isn't this sort of unprecedented? And the reality is, of course, no, it's not in any sense of the world. What was unprecedented was the UK's position at the start of the Industrial Revolution. I mean, if we just look at the longer-term history, what China is doing exactly replicates what the UK did during the period when it was the manufacturing center of the world, what the US did. I mean, to give you some numbers, right? At the peak, the UK consumed 80% of the world's iron ore with 0.6% of the world's population. It consumed over 50% of the world's copper with, again, 0.6% of the world's population. The US at its peak consumed 60% of the world's copper with, whatever it was, 6% of the world's population. China is now at 50% of the world's copper demand, but with 16% of the world's population, which is really out of kilter here. It was the Western world development, not, I think, what we're seeing in China. And then to the point of metal intensity, yes, it declines, right? Yes, the service sector gets bigger, and as the service sector gets bigger, that is a less metal intensive sort of form of economic activity. But that metal intensity decline does not offset, I would argue, the continued need for overall economic growth. So yes, I wouldn't be arguing for China sort of continuing to go at 7-8% copper demand. I think that number falls. But then it's picked up by what we see in that broader development in Asia, in Africa, in Latin America. I think it's almost impossible to construct a scenario where you have world economic growth without at the same time demand for copper continuing. I mean, you know, if we just sort of look back and sort of really big picture, last 250 years, all copper demand has ever done is grow at a trend 3 to 3.5%. If we look at the Great Depression, the Great Recession, World Wars, these are little blips in an otherwise inexorable trend that has economic development synonymous with raw material production. And there's a very good reason for it. And of course, that reason is highlighted in any sort of textbook on Austrian economics. We seem to have sort of forgotten that. We all want to live. Elon's going to plug us into the matrix and we can all sort of go home. But the reality is somewhat different than that. Right? Raw material production will stand as the basis of economic development going forward, as it always has done.
Okay, on that point, with the perspective of 200 years, I'd like to open up for any questions. Does anyone have any questions on this topic at all? All right, just here in the front row. Do we have a microphone?
I will also add just quickly that China exports. The copper does not end up in China. So the installed base is different. They import a lot, but then it ends up in a washing machine in Milwaukee, Wisconsin. So
that's a really
that's a very important point.
Sure. Anyway, question.
Sala from Finity Asset. A question to the panel. Does the panel think that the demand for copper is underestimated considering the EV? Because most of the reports I see, they just calculate how much copper is going to be used in the EV cars. They forget the fact that the infrastructure to cater for it is going to need huge amounts of copper. For example, I bought my EV car, BMW i3, 4 years ago. I miscalculated because I forgot that the garage to the house is quite a distance. And suddenly I had another £3,000 to spend. And most of that expense was the copper from the house to the garage. And I think a lot of the forecasts are forgetting that. Blocks of flat needs huge amount of copper from the grid to the flats because every garage in the flat is going to need one.
But,
so just
well, by show of hands, who here has seen a battery taken apart? Anyone here? So I was at the Spears Technologies in Oklahoma City. They do warranty work for all the car companies, the batteries. And they took apart a Nissan Leaf battery. And the anode is a sheet of copper. You never hear copper mentioned when they talk about lithium-ion batteries. And when you talk to the scientists there, and I said, what's the single heaviest component in that Nissan Leaf battery? Copper. 30% of the weight's copper. Interesting. Then when you look at these big sheets of copper, batteries that are, when they make the plates, the sheets, what they do is they stress it thinner and thinner and thinner. But you can't make the copper too much thinner because it tears and you start over again. So you get to a point where the thickness of the copper in the anode, it's just a stationary. Then you can tax the other components. So
what about the charging?
If you have 10% penetration of electric vehicles with a magic wand, you roughly need 1 million tons copper more per year. The market is 24 million tons, as we all know. 20 million tons comes from mining, 4 million comes from recycling, thereabouts. The infrastructure component, once again, the invisible hand manifests itself. If that's going to be 1 million tons, there's a hell of a lot more copper in the infrastructure required to fortify your house, your apartment building, the overall system, if everyone starts adopting these things. So I don't think it's been modeled, Paul.
Yeah, just want to...
We modeled it, so clearly if you want to read Bernstein research, you can find it in depth. But look, I mean, you can make an estimate of it. We've looked at the impact, for example, in terms of grid. I mean, if we all move to electric vehicles, of course, we're going to be replacing petrol with electricity. That electricity is going to require a build out of both distribution and production. You can get a number there. You can look at, for example, the charging infrastructure and the amount of copper that would be required there. So, that's always been one of the reasons why we, you take the 10% million ton per annum. We've always then sort of said, look, we think it's going to be on top of that. So, I mean, I think the reason why you then start. The industry takes a pause here, certainly in the modelling of it, is you look at the kind of quantums that are involved. I mean, not just in copper, but also in cobalt and nickel. I mean, these are staggering numbers, right? I mean, you take the super cycle phenomenon, and I mean, not that I want to make this all about copper, but, trend supply growth over that period, right, was about 2.4%. 1.7% came from new projects, 0.7% of it came from mine expansions and life of mine increases, right? But 2.4% trend growth in supply, despite going up to $10,000 a ton, the highest ever nominal price for this commodity in human history, right? Chile entered the super cycle producing 6 million tons per annum. Chile left the super cycle producing 6 million tons, which speaks to Gianni's point. I mean, so then you start sort of saying, well, look, let's have 1 million tons here, 2 million tons there. We're going to increase that growth rate. It gets really difficult to get the maths to work on how you're going to clear that, right, off of the supply base that we currently have without prices, doing what we've seen, for example, in cobalt and lithium. I mean, it's not, again, that we can't have it. It's not that we can't deliver it. But the time scales that it takes to get to that kind of point, the magnitude of the changes that you're talking about, even though the growth rates don't look as sexy as, say, for example, in the lithium market, nonetheless, the amount of capital that has to be put at work to deliver that kind of world is really, really quite significant. And again, let's not forget that 2 years ago, right, we're at the bottom of the worst sort of cycle we'd seen in mining since 1932. We were told that we would, would hit peak copper, peak steel, peak everything. We'd never need another mine again in any event, and therefore we could all sort of pack up bags and go home. To reverse that narrative, right, to actually come to the realization that perhaps the mining industry serves some kind of economic purpose after all, is more than a lot of analysts are prepared to concede.
Great. Well, on that note, I'd just like to end the panel. I think it's very interesting. I'd like us all just to thank our panelists for their thoughts today and coming on. And thank you very much for joining and listening to the panel.